Alrighty. So in today's video, we're going to be talking about how to manage losing trades, right? More specifically, we're going to be talking about how to manage losing credit spreads. All right. So here is an example. So let's say that you are bullish, right now on this market. So let's say you think that the market is going to go up. So what better way for you to put on a bullish trade or a neutral to bullish trade with the bull put spread, right? So if you don't already know, the bull put spread is where you sell an out of the money put option and then you buy a further out of the money put option, right? So at this point of time, you've put on this bull put spread, and then the market starts to go down. So this isn't an ideal situation for you. It's not an ideal scenario for you because you ideally want to see the market immediately go up, right? So what do? At this point of time, most likely if you take a look at your trade position, it's losing money because the market is coming down. So let's take a look at the P&L graph, right? So the first thing you want to do is analyze the P&L graph to take a look at, to see whether is there really anything you need to do at this point. So you can see that your short strike is at this point, which is 280, all right? So at this point down here, this is where your short strike is, and where your long strike is for the put option is 270. So what you want to take note of is this red line down here. So this red line is your break-even point. So break-even point basically is the place whereby past this point is where you will start to lose money at expiration, and then above this point at anywhere at expiration you will actually be in profits, right? So let's say for example the market has come down but it has not yet touched your short strike, right, at 280. So at this point of time the market is actually somewhere in this region. So if it's in this region, although, all right, so this is the current market price right now. So although the market has actually dropped and you are actually seeing a loss on your P&L, right, in your trade position, it's actually absolutely fine at this point, right? Because remember, if you are trading credit spreads, right, in this case the bull put spread, this is a neutral to a bullish position. That means to say that even though if the market does go down, and as long as it stays above your break-even point expiration, you will actually still be in profit. So there are two lines for you to take a look at here right now. So let me just clear this drawing so you can see. So if you see that there is this purple line, and then you will see that there is this green line, right? So this purple line basically is your P&L for today, right? So this purple line down here will eventually keep moving, right? It will keep moving as the days go by until it eventually becomes this green line down here. So this green line down here is your P&L at expiration. So between this time, right, from your expiration all the way to today, every single day there will be what is called theta decay, right? So this is time decay whereby the option prices will slowly start to decay over time, and as long as it stays above your break even, you're going to make this full profit. So right now, even though if the market goes all the way down to, let's say, 285, right, 285, you're going to see like you're having some sort of a loss, right? Maybe a couple of $100 loss. But at this point, there's really nothing for you to do. There's no need for you to panic, because as long as it stays here all the way until expiration, or as days go by, you'll see this purple line start to move up, right? It will start to move up until eventually becomes this green line. Now, on the other hand, if you were to take a look on the other side down here, which is past this point down here, this purple line down here will start to shift down, right? It will start to go down until it goes to the green line. So what does this mean, right? So it means that basically as long as, right, we will use the break-even point. So anything above this break-even point, you really do not have to worry, because this purple line will in the end start going up, right? So this is the effect of time decay, which is the benefits of trading a credit spread. So at this point of time, if you were to take a look at the charts, if you see that the market, as long as it's above your break-even point, anywhere above here, then there is absolutely nothing to do, right? So if the market is above the break-even point, do nothing. Now, what if the market starts to go below the break-even point? So this is where you might need to do something, right? Because past the break-even point, we know that this is where we will start to lose money if it stays there at expiration, especially if it goes past this point down here. You know that each day passes, it's no longer going to go up, right? But instead it's going to start to go down. That means it starts to lose even more money as each day passes, right? So what do? So the answer is that it depends on whether it's past the 21 days to expiration mark. So there are two reasons why we want to use 21 days to expiration as sort of like a marker, right, to decide whether we're going to do anything or not. And the first reason is that when you pass the 21 days to expiration mark, the chances of getting assigned on your in the money short put increases, right? Remember, if the market starts to go below your short put strike, there is always chance of an early assignment, right? Early assignment means that this buyer of the put option, they will start to exercise their option, and then you will be put 100 shares at $280, right? So that means you will have to fork out a capital of $28,000 to hold on to this position. Ideally, this is something that we do not want, and this is where a lot of people, when they're first starting out to trade options, this is where they kind of a little bit panic, because once they see their short strike being breached, one of the biggest fear is getting assigned. So if you want to reduce your chances of getting assigned, then you want to see whether it's past the 21 days to expiration mark, because whether you get assigned or not on this put option really comes down to how much extrinsic value left there is in this option, right? So the greater the extrinsic value, the lesser chance there is to get assigned, right? Because it doesn't really make sense for you to assign as the put option buyer, because if you were to exercise the option, then you will be giving up your extrinsic value, right? That makes no sense. If you want to profit on this put option as the put buyer, you can just simply sell off your put option. So when is the time where there is lesser extrinsic value, right? So the time where there's lesser extrinsic value is when it passes the 21 days to expiration mark, where it's getting close to expiration, right? As it goes closer to expiration, the theta decay starts to become even higher. So that's when you start to rapidly decay whatever value there is in the option. So this is where the chances of you getting assigned on your in the money short put gets higher. Now, the second reason why you want to take a look at 21 days to expiration is because there's already been studies done, the research done by the Tasty Trade team, that if you were to manage your trades, right, if you were to take off your trades at the 21 days to expiration mark, you actually see that you reduce your average loss significantly, right? So you can see that based on a $5 and $10 white put spread, right, if you hold to expiration, you can see that it's a few $100s, right? But if you were to manage it at 21 days, right, you close your trade out early, your loss has been reduced dramatically. And at the same time, you have higher return compared if you were to hold it all the way to expiration. So these are the two reasons why we want to use 21 days as a marker. So based on this 21 days to expiration, this is where we're going to have an idea of whether we're going to do anything or not. So with this in mind, if the market is below the break-even point and it's still above 21 days to expiration, guess what? You do nothing, because there is still time for the market to eventually rebound, right? So the beauty about the credit spread is that you actually already sort of have your maximum loss in place, right? Because you have already bought this put option down here. So you do not really actually have to worry, because you already have defined your risk. You already know what's the maximum loss that you could lose. So the market can go all the way to zero for all it cares. It doesn't have to bother you, because you already have your maximum loss in place, which is at the 270 put mark, right? So you cannot lose anything more than the width of this put spread, minus the credit, of course. So when there's still above 21 days to go, there's always chance for the market to come back, right? You let theta decay work in your favor. You continue to hold on to this trade, even though it can go all the way down, it can eventually come back up. And because there is still a lot of days left to expiration, the chances of you getting assigned is very, very low. Now, what if there's less than 21 days to expiration? So there are two things that you can do. Well, the first of which is to simply just take a loss. So if you were to take a look at the P&L graph down here, so anything that is below the break-even point expiration, we already know we're going to lose money. But if it's below this point down here, if you can see this point down here, the longer that you hold it, each day that passes, this purple line will start to accelerate to this green line down here, right? This is where it will be at expiration. So each day as you hold, you're going to start to lose even more and more. So that is why for me, generally, as long as it's past the 21 days to expiration mark and it's below my break-even point, I generally just take a loss. You know, I have many different trades on, so I do not want to try and salvage every single trade, right? Just remember, when you put on this trade, there's already a 78.43%, right? Around 70+% if you're going around the 25 delta mark, right? If you were to put on this trade. So there is always a chance that you can lose. So there's no need to always salvage every single trade. So if this trade is a loser, you can always put on another one. So you might be saying, you know, I do want to try and hold it, because if you hold it, you might go back past to this point, and then at this point on, right, you will start to make more money as each day passes. Now, definitely this is an option that you can do, but what if it further goes down, right? Then if it goes further down, then it's going to be much more difficult for you to eventually recoup back the losses, because it has to move a greater distance back up, right? So at the same time, when you're past the 21 days to expiration mark, don't forget you are now below your short strike. So as it goes closer and closer to the expiration time, right, the expiration date, your extrinsic value will get lesser, and it gets even lesser as the market moves further deeper in the money, right? As it goes all the way down, it goes deeper in the money. That's where your extrinsic value will start to shrink as well. On top of that, your extrinsic value is already starting to lose even more because of theta decay. And that's where you're going to start to have a very high chance of getting assigned, and then you'll be put the 100 shares, which I'm pretty sure that is not a situation which you want to get into. By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. Alright, back to the video. So that's the first thing that you can do, which is simply just to take a loss. Now the other thing is that if you don't want to take a loss and you still have a bullish view, right, you still think the market can possibly rebound, then you can roll it, right? You can roll it if you can get a credit. Now, rolling credit spreads is very different from rolling just a naked short option. Let's say, for example, a naked short put. If you roll a short put, chances are that you can always roll for a credit. But when it comes to a credit spread, it is not always that you can get a credit, right? It really depends on whether the price is closer to the short put strike or the long put strike. If it's closer to the short put strike, then yes, you can most likely roll for a credit. But if it's closer to the long put strike, then chances are that it will be a debit. Then at that point of time, then it wouldn't really make sense to roll your credit spread. So the process of rolling a credit spread is actually pretty simple. What it's actually doing is that you are closing out this short put spread, and then you are selling another put spread, right? So in actual fact, what you're doing is that you are closing out your current put spread for a loss, and then you are selling another put spread with a credit that is more than the loss, so this way you get overall credit. So maybe when you close out this put spread, maybe you have to pay out $5 for this, and then when you sell the put spread again at a later expiration date, so maybe let's say there's 21 days to expiration left, so what you want to do is you want to roll to a the closest expiration date that is around 45 days to somewhere around 60 days to expiration date, and then you will be selling this put spread maybe for $5 and say 50 cents, right? Maybe $5.50. So this way you get a credit of 50 cents. So when you're doing this roll, what you're essentially also doing is lowering the maximum loss on this spread, right? So maybe your maximum loss for this spread could be maybe say $8, but now that you receive 50 cents for this credit, which means to say your maximum loss could now be just around $7.50. And if you just keep rolling this each time, whenever you get a credit, you're just slowly reducing the maximum loss until eventually the market comes back up. So this is something that you can do if you want to roll your credit spread rather than just take a loss. Now, the other question you might have is, you know, Davis, what if the market actually comes down, but it's still above the put strike, right? And then at 21 days, it's still above the put strike, but then I'm still at a loss, right? If you were to look at your trade position, you will see that this could be a loss. So what do? Do you actually take out for a loss? So for this, it really comes to you, right? Remember, if you were to take a look at the P&L graph, anything that is above the break-even point, we are still in a profit, right? Technically, we are still in a profit above this break-even point as long as it stays there by expiration point. So if it's above this point, let's say for example the market is down here, you may see that you're still in a loss, right? You may still see that you're currently in a loss, but then it's not necessarily a loss if it stays there all the way to expiration. So at this point, you can either just choose to hold on to this position all the way to the expiration date, or at this point, you can just roll it, right? You could just roll it and get even more credit, right? There's a chance that if you roll it when it's above the strike, you can get quite a bit of credit. So this way, you are prolonging the trade, and at the same time, you give it chance for the market to eventually go back up, and then you could profit on this position as well. So it really comes down to you at this point. Okay, so this is for the put spread. Now, what about for the call spread? Well, the call spread is pretty much just the opposite, right? So if you are bearish, let's say you're bearish on the trade, you put on a call spread. So if the market is below the break even, basically you do nothing, right? Similarly, so the break even will be above this time. And if the market is above the break even, right, in this case, then again, we take a look at the 21 days to expiration point. So if it's more than 21 days to expiration, you do nothing. And if it's less than 21 days to expiration, well, you either take a loss or roll if you can get a credit. Simple as that. Now you might be asking, but Davis, what about turning it into another trade, right? Something more advanced, more complex. So for example, you might turn the short put spread into a short put, right? So for example, you have the short put spread down here, right? So you have the short put and then you have the long put. So some people, what they do is that when the market actually goes down, right, they see these two as a separate trade now, they split them up because you will be losing money on this short put position, but you will actually be making money on this long put position. So what they do is that they sell off this long put position, so they make money on this long put, and then for this short put, what they do is that they roll it down, right? They roll it down. So by rolling down, what you do is you get additional credit as well, and at the same time you reduce the break-even point of your new trade right now, which is a short put, and then you give some time for the market to rebound, right, if you're still bullish on this trade. So should you actually do this or not? So my take is that I generally like to just enter the trade and exit the trade as the original trade. Right? If I entered it as a put spread, I want to exit it as a put spread. If I enter it as a call spread, right, a bear call spread, then I want to exit it as a bear call spread. Because the reason is that when you turn it into the short put, you have totally changed your risk profile. So let's say, for example, if you receive, say, $2 for this credit spread, right, and then the width is $10. So the maximum loss is pretty much basically the width minus off the credit, right, which is $2. So your maximum loss will be $8, right? $8 would be your maximum risk, which is $800 per credit spread that you put on, per put spread that you put on. Now, once you have changed this into a short put, you have totally changed the dynamic of this trade, because now no longer is your maximum risk $800. Your maximum risk is all the way to zero, because at this point of time, remember, you have turned it into a short put. So let's say you have rolled the short put down from 280 to 270. So 270 is now your short put at, right? So now you no longer have any protection below. You have no protection below, then in the event whereby the market crash, then you can lose much more than this $800 which you initially had it on, right? The initial risk when you put it on. So that is why I do not really like to put it on. Can it work? Definitely can work if you are right on the trade, if it goes up. But if it goes down, then you're going to lose much more than what you initially allocated to the trade in the first place, right? So that's my take on convert it to a short put. Now, what about turning it into a butterfly or an iron condor? So by turning it into the butterfly or iron condor, so it's slightly different from short put, because with the short put, you have turned a defined risk kind of trade into an undefined risk. But by turning it into the butterfly or iron condor, what you're doing is that you're still sticking to a defined risk strategy, right? You change it to a defined risk strategy still, where there's a maximum loss, but then now you've changed a little bit of the dynamic. So in this case, maybe for example, if the market goes up, then you say, hey, I want to change it to an iron condor. So you sell a put option here, and then you buy a put option here. So -1 and then +1. So down here you have an iron condor. So first of all, when you do it this way, when you sell a put spread, you will receive a credit as well. So this way you actually reduce your maximum loss, right? So if previously your maximum loss was $800, let's say your previous trade, right, your call spread, let's say you put on this call spread down here, the maximum loss is $800. Now by putting on this spread, let's say you receive $1 in terms of credit, right? So a dollar would basically be $100. So you will minus off $100 from your maximum loss. So now you have turned this trade into a maximum $700 loss because you have received credit for this, and the market can only be at one side at expiration, right? So this too has to be the same expiration date, by the way. You want to keep it at the same expiration date so there's no messing around with the different kind of duration and timings, right? So when you do it this way, you reduce your maximum loss. But the problem with this strategy is that you actually also have reduced your probability of profit, right? When you put on this trade, your probability of profit should be maybe around 70% odd, right? Let's say 75% if you put on roughly around a 25 delta for the short strike. So your probability of profit will be around 75%. But because you have put on this put spread, suddenly you have totally changed the dynamic of this trade, and then now the probability of profit is going to drop. It's definitely going to drop, and it's probably less than 50% because now you have really tightened up this space where it can be in profit, and in the case where the market goes down, it doesn't really have that much room right now, right? It doesn't have that much room for you to be in profit, and you probably have to hold on to this trade for a longer time because now you have the friction of the short put spread. Because even though you're making money on the call spread as the market comes down, you're losing money on the short put spread. So that is why I don't really like the idea of turning it into a butterfly or iron condor, because once you do it, you're pretty much like, you're throwing in the towel, right? You're pretty much saying that, I don't think I can really win, I just don't want to lose that much. Because if you think about it, if you were to place this iron condor at the start, you're able to get it at a much wider length, right? You will get a much wider profit zone. So let's say, for example, you have the 280 and the 270 put spread. So this makes the iron condor. So the iron condor previously, you may also, let's say, for example, you get $1 or maybe $2 for this, and then you get it at a much lower strike price, right? Making your iron condor profit zone much wider. But because the market has gone up and then you sell the put spread above, what you have done is you actually gotten the same credit, but now you got it at a higher strike price. So in a sense, I feel this is a little bit of a disadvantage because you could have gotten a wider profit zone, whereby if the market did come down with the original iron condor, if you had put it on this way, you would have been in a profit. But right now, you have to settle for a smaller loss. So this is my take on turning into a butterfly and iron condor. So I don't really do this too, but I know some people do, and whether you want to do it or not really comes down to your own discretion. But I do think that it is much better if you just left it as the original trade and then just either roll it by itself if you can get a credit, or just cut loss and then just wait for another opportunity again, right? So remember, there's no need for you to win every single trade, right? The probability of profit is already there. You have a 75% probability of profit. Let's say you put on this trade for 75% probability of profit, then guess what? You will win 75% of the time. And that also means that you have a chance to lose 25% of the time, right? So you will have winners and losers. You cannot always try and get a winner out of every single trade. Right? The best thing for you to do is just keep on putting the trades, so over time the probability will play out. Just like if you were to flip a coin, say just 5 times, it's easy for you to get 4 hits and just 1 tail, right? It's very possible. So let's say each time a hit is a loss, so you could get 4 losses and then 1 win just by flipping the coins 5 times. But if you were to flip the coin 500 times, 1,000 times, then guess what? It's most likely going to be around 50%. So it's the same for your trading, right? The beauty about options is that you already know your probability upfront. You have the rough estimate of your win rate upfront already when you put on the trades. So all you have to do is just let the probability play out as you put on more trades. So what really matters is to position size your trades properly according to your capital allocation and manage your risk well. That means to say you do not put such a big position on for your trading account size, right? So if, for example, your trading account size say is $10,000, then you do not want to risk more than $500 to $700 per trade. Right? If you were to put on one credit spread and it's going to reach say $5,000, then that is way too big. So that is where you'll start to panic as the trade goes against you. So remember, keep your size small and then just let the probability play out in the end. Alright guys, so I hope this video has been helpful for you and it gives you a little insight on how you can manage your losing credit spread. So if you like this video, please give me a thumbs up and also subscribe to my channel so you can get more videos like this. And by the way, if you haven't gotten your free copy of the Options Income Blueprint, then you can go ahead and get it at optionswithdavis.com/blueprint. So if you are wondering still what are the best option strategies that you can use to get a consistent income, then there's no need to look any further because I've compiled the top 3 option strategies that can help you generate a consistent income every single month, and you can just use it to trade, just a few hours a day or even just a few hours a week. So again, if you want to download this, it's absolutely free of charge. Just head over to optionswithdavis.com/blueprint. Last but not least, I thank you for watching. I appreciate your time and may the options favor you.